Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
The tariff news, it just keeps on coming here. Trump says Mexico, Canada, and new China tariffs take effect March 4th. That's coming up soon. Let's get the latest. Brendan Murray, Global Trade Editor for Bloomberg News, joins us right now. Brendan, you know, it's tough to keep track here, but it appears that these tariffs are going to take place and maybe even some incremental ones on China. What's the latest?
Yeah, so Trump tried to clear up any confusion there was about whether the Canada and Mexico tariffs of 25% were going to take place on Tuesday, and he said they indeed will. And he added a bit of a surprise. He said, "Oh, and I'm also going to add 10% tariffs to Chinese imports," which he already imposed 10% tariffs on China. So this is another 10%, and that will also take effect on Tuesday. So we're looking at the three largest U.S. trading partners. About 40% of U.S. merchandise trade is done with these three countries, totaling something like $2 trillion a year. So he's turning the screws on China in particular, and trying to drive a deal, it sounds like, before midnight Monday into Tuesday with Canada and Mexico.
What's the off-ramp then?
The off-ramp is Canada and Mexico scrambling to show him that they're doing what he would like them to do on fentanyl trafficking and illegal migration. They have already done a number of things. So the question is, what exactly are the goals that they could reach, and and are those even attainable in the next 4 days now? So
all right, Brendan, dumb question of the day. How do tariffs work? Like, who puts the tariff on which party? How quickly does it happen? Can you just explain the mechanics here?
Yeah, it's a pretty quick switch that the directive comes from the president. It goes into the Federal Register. It is transmitted to the Customs and Border Agency, and they plug it into their computer system, and that system that importers and exporters are connected to, customs agents and the intermediaries of trade, that suddenly appears on their computer screen as it's another 10% in the case of China come Tuesday. So it all can happen pretty quickly. At the moment, these are just threats. The only tariffs that are in effect since Trump was inaugurated on January 20th are 10% on China. But there are a half dozen or so others, including tariffs on the European Union, that he's threatened to put in place over the next five or 6 weeks.
So now what? Like, if I'm an economist and I'm looking at my models, like, what am I plugging in now to know, like, what growth is going to be, what inflation is going to be, what personal consumption is going to be?
Yeah, Bloomberg Economics have done a lot of number crunching in this area, and they do show that the tariffs will have an impact on growth, on inflation. The freshest number we have was that the tariffs on the European Union that he's threatening will cut their GDP by 1.5%. Now, 1.5% sounds like a small number, but we're talking to an economy in the multiple trillions of dollars. So it's a lot of money. Businesses pay it, and then businesses pass those costs on to consumers. So it will. The goal from the Trump administration is to drive production to the U.S. But in the meantime, somebody's got to pay these tariffs, and until those jobs are created, as Trump hopes they are, it will have there'll be upward pressure on prices for the products that he's targeting.
Brendan, what do we know about from these countries, China, Canada, Mexico, in terms of retaliation? What is their policy, or what are they saying these days?
They're all doing something slightly different. Canada has said we'll hit $107 billion dollars worth of your products with the same tariff that you're going to put on us, 25%. Mexico has not been that specific, but they will also they've pledged that they won't just take it, that they will retaliate as well. China is a more interesting case. They have been very reserved in what they have targeted, but they've been sort of strategic. They launched an antitrust investigation into Google's operations in China. The total amount of tariffs that goods that they've retaliated against is only 14 billion or so. So they have, but what they're showing the U.S. is we can target not just your goods but also your big tech companies. So they're seeing Donald Trump's the pressure he's putting on, and they're responding in a way so far that's been reserved, but that can hit hard a big tech company like Google.
All right, Brendan, we really appreciate it. Thank you so very much. Brendan Murray, Bloomberg Global Trade Editor, joining us on Trump tariffs coming into effect next week on Canada, Mexico, an additional 10% on China as well.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get right to the Nvidia news, and nobody better to do that with than Gene Munster, managing partner and co-founder at Loop Ventures. Gene, the stock's kind of been up and down today. It's investors are trying to get a handle on it. What's your takeaway from the Nvidia news yesterday?
Well, the results were good, but not great. And specifically is the margin guidance at 71% versus the street at 72. And there weren't whispers that they were going to lower margins. I think that really stood out to me. The upside on revenue of a billion compares to the expectations of like $1.5 billion to $2 billion. And so I think that these were good in the sense they did raise on revenue, but not great. This definitely wasn't an Nvidia-like quarter. And I would say that if you put everything into context, and my sense is the stock probably trades lower today. I think that it probably should be down something like 5% ultimately, because effectively what they're doing is pushing the ramp to the back half of the year, especially on margins. That's when the margins, they said, to kind of go to 75%. And I would add one other piece to this is going into the print. I believe that the most important point was related to commentary about how sold out they were on Blackwell. This is a metric that they typically give. And last quarter, they said they were sold out for basically 3/4 of this year. They were radio silent on the topic. They surprisingly didn't get asked a question on it. But I think that Jensen's comments about the need for compute being 100 to 1 million, I double checked that on the transcript, 100 to 1 million times more compute needed for reasoning and physical AI and robotics AI, that increase in compute, I think gave investors some optimism that, well, this year might not be the year that 2026 is going to grow faster than what people think. And so said a different way is that the results and guidance don't give a ton of optimism, but if you look at where this ultimately could go, if you take what Jensen is saying and divide it by 10, that means they're still going to comfortably beat the numbers next year.
Okay, there's a lot to unpack with that. So let's go back to gross margins for a second. Based on their call that gross margins will hit 75% in the back half of the year, when do we think they're going to bottom?
So they answered that question on the call, and they kind of sidestep it. But if you read between the lines, they probably go lower again in the July quarter. So there's an April quarter that we're in right now, then they go to the July quarter. My guess is they probably bottom then at around 70%. So effectively going from 70 to 75 over 6 months is a pretty big jump. At the time of the call, the stock was up 2.5% about 2% in after hours. When they came to the last question on the call, which was related to that ramp in margins and how realistic is it if we have more export controls. And the answer was, we don't know how export controls are going to impact our business. And immediately the stock went from up, call it 2%, to down 0.5%. So we saw basically a 2% move in it. And so I think that speaks to investors saying, like, that's a risk here, is like, are we really going to get to that margin ramp? in your setup here, you talked about the 73% margins for a tech company, for a hardware company. I think at the end of the day, they're still remarkable. But for these stocks to keep working, you need to have margins at a minimum stable and growing. And I just want to put one final thought on this, Alix, is that ultimately, I think margins will get back to that 75%. I don't know if it's going to be in Q4 or early next year. But if the ramp is what I think it's going to be for next year, I think we're going to get back to some go-go days in Nvidia.
Gene, the driver for this stock, tremendous performance over the past 2 years, has been beat and raised by a certain order of magnitude. If for no other reason than the law of large numbers, that order of magnitude likely will be lower. Can this stock continue to work with just the law of large numbers, not giving you that $2, $3, $4 billion beat and raise every quarter?
I think it can. And just to put in perspective, we've gone from a $20 billion business a few years ago. It's going to be about a $200 billion business this year. But there still are companies, Apple's a $400 billion business. I mean, you can still continue to grow from that. And it doesn't need to have that breathtaking growth. And I would come back to the central question here. It's not about 2025. It's the 23% growth in calendar 26. And do you think that the number is going to be higher or lower than that? And ultimately, I think the number is going to be higher. I think we're going to get back to a point where we, despite the law of large numbers, we get to some of those improving upsides and beats. And it just comes down to what I think is a large TAM and what I still believe is a competitive advantage that GPUs have over custom silicon. And we'll see how that plays out. But that's essentially the debate that's going on right now, is just how much compute you need and how defensible is Nvidia. I think there's a boatload of compute, much more than we realize it's going to be needed. And I think Nvidia is in a great position related to that. We're going to have to wait to get to those results. But I think anticipation of that is going to be positive for the stock at some point this year.
Gotcha. So it's basically like the story is still intact. This is now just a timing issue and a little bit of a macro issue when it comes to tariffs. Am I reading you right?
Yeah, that's going to be the debate. That's the bull case. That's the side that I'm on. Mm-hmm. Still think we're early in AI, and I think Nvidia is going to benefit. The bear case is that we're seeing law of large numbers, less beats, and you're going to have a compressed multiple in that situation. But the central question, again, comes down, bears or bulls? Do you think they're going to beat the numbers next year?
Yeah.
Yep. That's been the tech call for such a long time for a lot of different names. And Gene has been there doing this stuff for a long time, and he's got the perspective. So we really appreciate getting a few minutes of Gene Munster's time. Folks, again, he was there for the birth of the internet, literally, and calling it from an investment perspective, helping people understand what this whole internet thing is. And he's doing the same thing here for us and for a lot of his clients as it relates to AI. We appreciate that. Gene Munster, managing partner and co-founder at Loop Ventures, out there in that tech hub of Minneapolis, Minnesota.
Oh, yeah. There you go.
There you go.
Hold.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
So then let's get to the markets and kind of what do you do when we have the continued tariff threat? It feels like we are counting down by days until we get that 25% tariff on goods from Canada and Mexico, an additional 10% on Chinese goods. Markets mixed. NASDAQ still off by 0.4%. We cannot seem to keep the rebound that we see in the futures market. Well, joining us now for more on how to handle it is Frank Monkam. He is head of macro trading over at Buffalo Bayou. He joins us on the markets. Frank, you've been in this market for a long time. How do you protect yourself right now?
Listen, it's an exercise that requires kind of short-term protection and long-term protection here. In the short term, obviously, if you're worried about, the vicissitudes of having headlines after headlines around, the policy agenda coming from the administration, then I think you've got several instruments that you can use, whether it's in the equities market, you got short-term options, even though the VIX is kind of up to 18, 19, close to 20, is still relatively fairly priced, in my opinion, based on the level of uncertainty that we're still seeing in the marketplace. But if you're willing to kind of ride it out, I think we're probably going to be in a choppy range here for a while. And if your medium to long term view is that we're looking to probably see a bit of a correction here in the markets, and I think downside protection looks really, really cheap, in my opinion. We're in a situation where it's really hard for equities to really get to escape velocity to the upside, given all the uncertainty, given where valuations are. I'm not saying, you want to be bearish, but it's just, I think the key word is the vulnerability. The market is super vulnerable when you're trading at these kinds of valuations, and you've got this uncertainty, and you've got, the DeepSeek thing is nothing to scoff at. I think, we see the Nvidia earnings yesterday that are failing to kind of lift the market up. That says a lot about the momentum up.
But on the flip side, I would have said, I kind of went into yesterday, Frank, saying I thought the risk to the market with Nvidia was everybody's been asking for or saying, when are we going to get a real correction? 7, 8, 10, 12% correction. Yeah. And if Nvidia really disappointed last night, maybe that would have been a catalyst. Yes. Their numbers were kind of good enough just to kind of keep everybody kind of happy, I guess.
No, for sure. I think the numbers were, all things considered, kind of middle of the road. And, it allows us to remain kind of steady here. But this vulnerability to me isn't gone, right? I mean, we're seeing more tariffs headlines today. There's a sense that the market is seeing a bit of sort of tariffs fatigue here a little bit.
Yeah, a little bit.
You're definitely seeing that being reflected in the bond market, where initially you saw bonds, selling off pretty aggressively with 10s, testing again 360, 370 almost, but now we're back to 325, 330 level, and it just kind of goes to show that the convexity for bonds remains kind of to the downside on yields, given, I think, one, the fact that, I think growth is regardless of what we say, tariffs, there's an inflation risk there, but it's inflation expectations more so than anything else. But growth is a presently observable data you can see, right? And then economic indicators have been kind of rolling over, economic surprises are coming off. And you also have an administration that's been adamant in terms of trying to bring yields down. So whenever you're seeing kind of growth data looking like it's softening a little bit, I think yields are going to come off pretty substantially. And I think one of the things also that I've looked at over the last couple of weeks here is how gold has kind of looks like it's pausing a little bit. And what's happening there, because I think a lot of the safe haven flows have been going into gold, because obviously treasuries have been kind of not very desirable at this point in time. But now that treasuries have seen a bit again, gold is kind of, being kind of left orphaned, not orphaned necessarily, but, you're seeing some profit taking happening with obviously crypto also coming off. So that's also something I'm keeping an eye on as it pertains to the relationship between gold and treasuries.
What about oil? So you used to work at Gunvor, which is an oil trading firm. This is a few years ago, but when you look at where we are in oil right now, what are the good trades? Like, what range are we in? What are you looking at?
Listen, for right, I mean, if you think about since the beginning of the year, what's been the biggest theme for oil? To me, it's been everybody's focused on policy agenda and all the tariffs rhetoric. That's fine. But to me, what's been unwavering from Washington has been that they're pretty adamant on making sure that energy prices stay in check. They ran on fighting inflation. I don't think they're going to let that happen. So I feel like there is a sort of call option from this administration on oil spiking, especially with Saudis having so much spare capacity. And frankly speaking, I feel like, at least based on the rhetoric, they've been pretty de-escalatory from a geopolitical standpoint. So it's hard, really. So the right tail to oil prices now, to me, is a lot thinner. Yeah. Right. But trading in from the downside and trying to be short.
Is that also why we got the Venezuela headlines yesterday? Like, oil didn't do anything.
Absolutely. Didn't go anywhere. Yeah. I think right now we've seen a bit of a bounce today. Last time I checked this morning, we're up like $1 or something, 20, 30.
Yeah.
That's just coming off of kind of oversold levels. And the market is really, really light from the positioning standpoint. If you look at open interest in the futures market, especially on WTI, it's back to 18 months low here. And that's just kind of leaving the market vulnerable to maybe a little bit of a short squeeze, but that is not really a sustainable rally, right? And what's really driving the oil market these days is that you have very little positioning from, sort of managed money. So you have a lot of fast money type CTAs players that are in the market, whipping the market around. And it just makes it vulnerable to test technical levels a lot faster than we think. Because the sort of thematic participation into the oil market really hasn't been there. I mean, we've seen a lot of themes with gold. We've seen a lot of themes even with copper and the AI story, but oil really hasn't had that strong of a theme. If anything, it's like, well, how low does the Trump administration wants to see oil prices go, and what's the level that's going to make big oil comfortable in terms of break evens, right? So it's a market to me that's still kind of bearish, but you just got to be watchful of the fact that there's very little liquidity in the market because, as I mentioned, managed money really isn't there. So you can see these random spikes that are just short squeezes that could go a lot farther than you think. Sometimes you think it'll be $2, it could be $5. So you have to respect those, but I still think it's a market that wants to go lower.
All right, you got a great deep voice. If this whole investing thing doesn't work, you got a career in radio. I'm telling you right now, man. Frank Monkam, thank you so much for joining us. He's head of macro trading at Buffalo Bayou, which, by the way, is a whole nother discussion where that name comes from. But we'll talk about that at another time. So, Frank, thanks very much for joining us here.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.